What's going on, folks? Good afternoon. So I'm pulling the trigger short here on the NASDAQ, putting a limit order below the previous day's low and scaling profits as it's dropping down into my discount targets. And again, because we're in a consolidation profile, I want to make sure the trader's getting paid and I'm leaving the day green. So with that, doing a market review here after the recording of the trade so you guys can see the trade, but I want you guys to also understand why I'm taking the trade, how I have the confidence in the setup, stop loss, how I'm managing different accounts, and how all that comes together so that you guys can see what's possible with this skill set and what you can do with learning how to read price action at a high level. So with that, I hope this was insightful. Enjoy the rest of the review. So consolidation, we leave the consolidation. Why do I expect that to be a breakaway gap? Because when the market is leaving a consolidation, we expect that first gap to be a breakaway gap. So that's why I'm using a lower time frame inefficiency here, because I don't even expect it to trade up into here. I do have my stop up here in case it wants to stab into that, but it shouldn't even get into that. So for your notes, when the market's leaving a consolidation, we want to see that form a breakaway gap. And that's what we have here, right? Extended consolidation. What time do they release the market? 10 o'clock, right? When the news comes out, that's time. But what I tell you guys I wanted to see in price. So time was 10 o'clock. Price is, I want to see the market leave this range. So if it behaves at time and price behaves a specific way, then that gives me confidence to know what I'm looking for. So consolidation at time, at 10 o'clock, I say silver bullet hour, it needs to get clean in this window. So what's it need to do? Leave this range. It doesn't. As soon as it leaves this range, it's not going to go up to these highs because at 9:30, it already ran higher. I told you guys, anyone that's short, their buy stop's already been knocked out here. So now this is a key high. And then again, that's all on the basis of what I shared top down, right? So you want to look at the top down analysis, what I shared on the daily time frame, which was this wick here, or as my man Tommy mentioned, we couldn't even get up to 50% of that wick. Great. It does what? Starts to sell off. What did we use? This discount wick here, 50%, we melted through that. Great. What's that telling me? It's really weak. So then what do we look for? The previous day's low here and that little volume imbalance that's tucked into there. So again, it's top down. Don't get too caught up with what I'm doing on the 1 minute time frame because that's not even it. It's the top down perspective that I'm using, which I am going to look to make a YouTube video on top down analysis and do a detailed teaching on that. And any questions you guys may have, obviously you guys are the community, so you guys can always bring questions directly to the chat, to these Zoom calls here, because again, myself, my team, we're more than happy to look over your trades, answer questions, whatever the case may be. Make sure you're getting the most out of the resources that we're making available, right? Because this is why we do it. So all these discount levels here gives us the confidence that the daily chart is going to expand lower. And then from there, on the hourly, we looked at what? Buy side here, it's already taken out these buy stops here. So now what's it going to do? It's going to work towards the low end of the range because we're in a consolidation profile, right? So because we see, I wish all these drawings weren't on here. This is, yeah, so you guys can see it stands out. So this is equilibrium. So what do we expect in a consolidation profile? The market's going to continuously refer back to equilibrium of the range. So once we trade up to the high end of the range and run the buy side, what's the expectation? Pull back down to the discount extreme end of the range. So once we trade higher, we attack the buy side here, and we dive back down into the range. What's that telling me? We're going to the opposing side of the liquidity, which is down here. So you see how we frame that top down from the daily, the hourly, and then dropping down to the 15-minute. Let me take all this off. It's way too much. Told you guys London high of the day. Breaks down, fair value gap, breaker, respect that. Trades higher, up close candle, respect that. And then told you guys on the 15-minute chart, as long as you remain below this fair value gap, I'm bearish. Why that fair value gap? Because this is an intermediate term high. We don't want to see this high taken out. So we have an intermediate term high. What's the draw? Relatively equal lows. I gave you this 15-minute gap here, extended that through. Said if we're going to be bearish, it's going to become an inversion gap. Right, and then you guys had all that before 9:30, and then we watched it unfold here to script. Yeah, so top down, that's really the main takeaway. What I'm looking at on the daily, hourly, and 15. And then you can see why it's easy for me to go into a 1 minute, a 15-second chart and know what I'm looking for because I have all these factors behind me here. So on the 15-minute, we trade up to that imbalance. We do what? We reject it. And we also do what? fail to reach, we also fail to reach consequent encroachment. So it trades higher, stabs into that institutional overflow entry drill, and it can't even reach consequent encroachment. That's something we want to see. And then it breaks down. And then again, we get the market nosediving into the key levels that we're looking for. So one of the biggest purposes with the top-down analysis is to have what I call time frame alignment. What time frame alignment is it's where all the time frames align. So run a scenario in your mind here real quick. What's going to be a higher probability trade? A trade where the daily chart is telling you it's bullish, the hourly chart saying it's bearish, the 15-minute is bearish, the 5 minutes bullish, and it's just mixed, right? You can't clearly say, okay, the daily's bearish, the hourly's bearish, the 15 minutes bearish, the 5 minutes bearish, the 1 minute's bearish. What do you think is going to be a higher probability market condition? Conditions where all the time frames are in alignment, telling you one direction, or when it's mixed, when, well, the daily chart could really go anywhere. The 15-minute, well, shit, I mean, there's equal highs, there's equal lows. I don't really know. What's going to give you higher probability trading conditions? Obviously, the one where everything's aligned. But that's not something we really think about when we sit down at our charts. So what we want to look at, the biggest leverage trades, the best trades, we want to look to take when there's time frame alignment. And I ran you through it pre-market, and I just ran you through it again here in the review. So it's how all those levels come together and just make a beautiful tapestry to tell you where it's likely to go and when it's likely to run there. Because then when you have that time frame alignment, that's where your highest probability setups are going to be. That's where you see, I want to get in not just one account, but I want to strangle the market. I want to get in on multiple accounts. And it's because when I have all those factors there, I'm just ready to jump on it because I've seen it enough. I've studied it enough to recognize what these A+ setup opportunities look like. And when they form, I want to be all over them, right? And that's essentially what it was that I was doing here today. I get a question on trading minis on funded accounts, right? So that was a funded account. I think you guys saw the balance, whatever. I'm not sure if that's in there, whatever. That doesn't really matter. The most important thing is how it's being managed. That's one thing I want to share with you guys. Because a lot of times I'll get asked, how do you trade a mini on a 50K account and not blow it up? Well, when I'm trading this account, I'm only using a 10 handle stop loss. I don't go over a 10 to 15 handle stop loss. So if you guys will recall as well, remember I shared with you guys, I personally like to trade the 1 minute chart and 30-second. Like that's what I did in the trade on the AMP Live account, but also on this account here, I use the 15-second. So generally the 1 minute's my main time frame for entering. But remember what I told you guys, I can teach you to teach any time, trade any time frame. I can teach you how to trade a 1 minute chart, a 15-second chart. I can teach you how to trade a 1 minute chart, or sorry, a 15-minute chart rather, an hourly chart, because it's all the same thing, right? So that 15-minute inversion, when it's hitting that on the 15-minute chart, that can be your short. I personally don't like that because then the risk would be big on a 15-minute basis, and I just don't want to trade with that size of risk and low leverage. But you can still do what I'm doing on a 1 minute on the 15-minute. You see how that comes together? So I'm saying that to say, when I'm trading these accounts where I don't want to have a lot of risk per trade, I need to only find opportunities where I can frame risk to 10 to 15 handles. Because I'm very comfortable trading one mini and risking $200 to $300 to make 400 to 600, which is anywhere from 20 to 30 points. So how do I do that? Well, what do we have here? If you guys will recall, let's go up to the 2 minute time frame. This new week opening gap here, we're consolidating at these levels. Why do I want to see the market leave the range to the downside? Well, because we're also doing what in the process? We're also leaving the new week opening gap. So we're leaving the consolidation range, but we're also leaving the new week opening gap. So just like the 15-minute chart, how when we're hitting that, I say, I want to see it be resistance and send price lower. Well, I want to see the same thing here with this new week opening gap, right? Drop below it, trade up into it, use it as resistance, and sell off. So I had to get in sync with the run that was already happening. So how do I do that? Well, all this logic here is still important, right? We left the range. Now this new week opening gap is going to be what? Resistance. Because it's going what? It's going lower. So now when I drop down to the 1 minute time frame, like I said, the ideal short would have been here. We drop down, we leave new week opening gap as we're hitting it as resistance. That's right where I was smacking the short on this account here. As we're trading up into that gap, I'm smacking that short right in there. But because I wasn't able to get that, I had to get, again, a entry that's already occurring as the price runs developing. So then what I do is with that same understanding that it's already done here, and look at the respect, and this is a 15-second chart. Look at the bodies. Look at how it stops at that new week opening gap. Drops down. That's beautiful. Beautiful resistance right there. It does what from there? It leaves that to the downside and breaks down. So now what do I trust this up close candle here becoming? A bearish order block, right? So as it's trading up into this, I'm trying to get the short inside of this volume imbalance here, because the volume imbalance also overlaps with the low of the order block here. So I'm timing the entry and I'm shorting the volume imbalance, shorting the order block with a stop above the high here. And now I have about a 14 handle stop loss. So that's how I get really tight risk, because in my mind, we've already done what? We've already left the new week opening gap. I already taught you why that should be a breakaway gap. We shouldn't even fill in that gap. Why? Because it's leaving a consolidation. Don't take my word on it, back test it, and you'll see it's absolutely money. So we don't even want to see this fair value gap traded to. It's already done what? It's already worked this fair value gap and the low end of the new week opening gap. So if we're going to get down to that sell side, it better giddy up and go. So that's why I can sell short here and with a stop comfortably above this high, because it shouldn't get through all those levels if it's going to be good. And then if it does, then I'll take a small loss and I'll come back the next day and make it back. Easy peasy.